How can you save some money on your next purchase of real estate or even refinance? The mortgage interest rate buy down option. Let's take a look at that, what it is, and then a scenario for how you could make it work for you. So the mortgage interest rate buy down, what is it? It's essentially a trade between you, the borrower, and your bank or mortgage company, the entity that's lending you the money for the house. So you're going to trade them some additional cash up front for a lower mortgage interest rate and therefore a lower mortgage payment. So what does that mean practically though? So you can see on the board behind me here that I grabbed a scenario from a mortgage broker friend today, and rates have been all over the place, but the principles will still apply. And when mortgage interest rates were very low, which has been the last few years, the rate buy down relationship wasn't good. Essentially, the amount of cash that you had to give your bank or mortgage company up front and what they were willing to reduce the mortgage interest rate by, it just didn't really play out. It didn't make sense. Now that mortgage interest rates have gone up a bit, the relationship between the cash that you give the lender up front and their willingness to reduce the mortgage interest rate has improved for you, the borrower. So here's a scenario. It's a $500,000 loan amount. Borrower's credit score was 780. They were putting 10% down, so that means it's a conventional loan. We won't talk about FHA and VA. Feel free to call me if you have questions on that. But the difference is a 0-point rate, which you'll see at 7 1/8 or 7.125, and then a 1-point rate. Point is just a percentage of the loan amount. So 1 point equals 1% of the loan amount. 10 points equals 10% of the loan amount. And then 0 obviously means you're not paying anything to bring your interest rate down. So at a 0-point rate, you're looking at 7.125, and at a 1-point rate, meaning you gave your bank or mortgage company $5,000 in exchange for them reducing your interest rate, it takes the interest rate from 7.125 to 6.625 or 6 5/8. Now, you can see on the other side of that column there that the payment goes from $33.68 and change to $32.01 and change, meaning a difference of $167 per month. Now, whenever you do the math on that, you end up getting your $5,000 back in about 2.5 years. So if you stay in the home with that mortgage for at least 2.5 years, you will have gained your money back that you spent up front, and then it will be all profit from that point forward. Now, the reason that you would or wouldn't do this depends on your thoughts about the future mortgage interest rate market. If you think we're at a point where mortgage interest rates are maybe as high as they're going to go, and in the near future you're going to have the ability to refinance, you probably don't go all in on this mortgage interest rate buy down option. Vice versa, if you think we're at a point where rates are pretty good and maybe getting higher in the coming months and years, then you would want to buy the interest rate down as much as possible, as long as the math works, right? Because you're not going to have the opportunity to refinance in the coming months and years. So those are my thoughts. That's what a mortgage interest rate buy down is. And if you have any questions, I'd love to catch up. Jeff Reber, 904-405-1995. You can shoot me an email, jeff@era.com, and I'll look forward to hearing from you. Take care.